Today we will be talking about the difference between index funds, ETFs, and mutual funds. Let's first focus on the difference between ETFs and mutual funds, and then we will explain what an index fund is afterwards. So what exactly is an ETF? Well, ETF stands for Exchange Traded Fund. But let's break it down further to better explain what exactly is happening here. Exchange traded means it is traded on a major stock exchange just like an individual stock is. There are 13 stock exchanges operating in the US, and the most common ones are the New York Stock Exchange and the NASDAQ. The New York Stock Exchange was founded in 1792 and has 2,400 stocks in it, and it includes more established companies such as ExxonMobil and Berkshire Hathaway. The NASDAQ was founded in 1971 and has 3,800 stocks you can buy that include more growth and technology companies such as Apple, Microsoft, Facebook, Amazon, and Google. Now let's move on to the four-letter F word in ETF, and that is fund. A fund is simply a collection of many different investments such as stocks or bonds. It could be as small as 10 stocks or as large as a couple thousand. So an ETF is simply a collection of stocks or bonds that trade in real time on stock exchanges just like individual stocks and can be bought and sold throughout the day whenever the exchange is open. Now that we know what an ETF is, let's move on to what a mutual fund is. A mutual fund is different from an ETF in a number of ways, but it is similar in the fact that it is still a fund, which again we described earlier as a collection of investments such as stocks and bonds. A mutual fund works by pooling money from many different investors, which is then used to buy shares of the individual stocks and bonds. The minimum initial investment is also usually higher than ETFs and can be anywhere from $1,000 to $10,000. Whereas for an ETF, you can buy as little as one share at a time, which is usually under $100. A mutual fund also only trades once a day after the market closes for the day. This means that the price does not fluctuate throughout the day like an ETF does, and the price is updated only once at the end of the day. Typically, mutual funds have much higher fees than ETFs do, but it depends largely on if they are actively or passively managed. And this is where we get into index funds. ETFs and mutual funds can be either indexed or non-indexed funds, also known as passively or actively managed. Index funds are passively managed and simply track a predetermined set of investments called an index. The definition of an index is something that gives an indicator, sign, or measure of something. An index fund will invest in the same investments as the underlying benchmark index. To keep this simple, let's look at some common indexes for the US stock market. There are many different indexes when we are talking about the US stock market, but the most popular one is the S&P 500. The S&P 500 measures the value of 500 large companies listed on the New York Stock Exchange and the NASDAQ. So if you buy an ETF or a mutual fund that tracks an index such as the S&P 500, then you are buying a stake in 500 different US companies all at once. It would be the equivalent of holding 500 index cards in my hand with the name of each individual stock written on each one. The stocks in the S&P 500 are organized based on company size from largest to smallest, with the biggest companies getting a bigger percentage of the index. Here's a little bit more background information on the S&P 500 to help you understand better. S&P stands for Standard & Poor's, which is the financial company that created the index. Standard & Poor's created the index to measure the health of the US economy, and it represents companies from all sectors of the economy. And companies have to meet certain requirements to become eligible for inclusion in the index, such as they must be headquartered in the US, they must have a market cap of at least $5.3 billion, and they must be profitable for at least 1 year. And there's more requirements, but those are just some of the noteworthy ones. Because of this, you can feel good knowing that you are only investing in large, profitable companies that have a low chance of losing all their value, and therefore all of your money. Another popular index is the Wilshire 5000, which includes all the stocks listed on the US stock market. The main difference between this index and the S&P 500 index is that it includes smaller companies that have higher growth potential. There are many more index funds that exist that focus on a variety of different investments. For example, there are index funds that track only small companies, mid-sized companies, or large companies. And also there are indexes that focus only on specific sectors such as real estate, technology, or consumer goods, just to name a couple. But for this video, we will only focus on the S&P 500 and the total stock market indexes in an effort to keep things simple. So let's go ahead and take a look at the holdings of the S&P 500. We can see all the holdings of the S&P 500 listed here with percentages assigned to each one. You can see here the top 10 holdings are very large, well-known companies that include Microsoft, Apple, Amazon, Facebook, Johnson & Johnson, Berkshire Hathaway, Google, Procter & Gamble, and JP Morgan. So basically what this means is that when you buy an ETF or mutual fund that tracks the S&P 500, you are buying a stake in each of the companies I just mentioned, plus 490 more companies. So for every $1,000 you buy, you would be buying $56 of Microsoft, $48 of Apple, and $38 of Amazon based on the current percentages of the index. Now that we understand what an index fund is, that leaves only one more question. What is a non-indexed ETF or mutual fund? Well, a non-indexed ETF or mutual fund is one that does not track an index, but is instead actively managed by an investment professional, meaning someone is making decisions on which stocks to buy and sell, and it is up to the investment manager to decide. Of course, the goal of all actively managed funds is to outperform the returns from a passively managed index fund such as the S&P 500. But is this a reasonable assumption? Do actively managed funds have a history of beating passively managed funds? The answer is unfortunately usually not, meaning a majority of actively managed funds over long periods of time tend to underperform passively managed index funds. The bottom line is that if you invest in an actively managed non-index fund, there is no guarantee that you will do better than investing in an index fund such as the S&P 500. Also, when you invest in an index fund that tracks the S&P 500, you never have to worry about your investment advisor making bad investment decisions on your behalf and losing your money. Also, because an investment professional is making investment decisions for you, you will have to pay management fees, which often result in you paying a higher fee as compared to buying shares of passively managed index funds. I want to talk a little bit more about fees because this is one of the biggest advantages of buying ETFs over mutual funds. When you buy a mutual fund, you have to pay an expense ratio, also known as an expense fee. The expense ratio is usually a percentage of money charged every year for the privilege of owning the fund. The average expense ratio for ETFs is around 0.26%. Mutual funds, on the other hand, have an average expense ratio of 0.73 for index mutual funds and 1.45% for actively managed mutual funds. But when it comes to mutual funds, not only do you have an expense fee, but you also can have more fees on top of that, such as an annual marketing fee, management fees, and fees when you buy and sell shares, which is called a load fee. And if you thought it couldn't get any worse, it does. Most financial advisors are actually considered stock brokers, which means that they aren't required to look after your best interests, as long as they suggest investments that are appropriate. For example, let's say I was your financial advisor and you were a young 25-year-old wanting to get started in investing. Based on your age, I could recommend you simply invest in the S&P 500. But instead of recommending an ETF such as IVV, which tracks the S&P 500 with a low expense fee of 0.04%, I could instead recommend an S&P 500 mutual fund that charges a 2% load fee to buy shares, which then I get a portion of as a commission. That means you would be paying higher fees for the exact same investment, but on the bright side, you're supporting your local financial advisor by paying him or her extra. For this reason, I recommend ETFs. They are easier to understand and more transparent than mutual funds, and you don't really need a financial advisor to figure it out. If you are young and looking to get started in investing, I recommend you buy an ETF that has an extremely low expense fee that tracks either the S&P 500 or the total stock market index. I recommend those two funds as starting points because they are highly diversified and millions of people invest in them. As you learn more about investing and your knowledge and confidence grows, you can begin to expand your investments and explore more exciting investment opportunities. But sticking with either the S&P 500 or the total stock market means you won't lose all your money, and when the stock market does go down, you can rest assured knowing that you and millions of other people are all in the same boat. So if you watched all the way to the end of this video, here are some top S&P 500 ETFs and total stock market ETFs that you can buy today. The most well-known total stock market ETF is the Vanguard Total Stock Market ETF that has a ticker symbol VTI. When you buy VTI, you are buying a piece of 3,528 US stocks, and the expense fee is only 0.03% per year, which means if you had invested $10,000, you would only pay $30 a year to own VTI. The most well-known S&P 500 ETF, on the other hand, is the SPDR S&P 500 ETF that has a ticker symbol SPY. When you buy SPY, you are buying a piece of 500 US stocks, and the expense fee is only 0.0945% per year. Some other good S&P 500 ETFs to consider are the iShares Core S&P 500 ETF, that is IVV. It has an expense fee of 0.04%. And the Vanguard S&P 500 ETF, also known as VOO, VOO, that has an expense fee of 0.04%. So those are some great ETFs you can buy today, but keep in mind there are thousands of different ETFs out there you can buy, and the ones I just mentioned are only the tip of the iceberg. And remember, the best time to start investing was yesterday, but the second best time to start investing is today, so don't wait. Guys, if you found this video helpful, please consider clicking that subscribe button. I easily put in 20 hours or more of work into videos like this between researching, filming, and editing, and I am always super excited when people can get value out of these videos. So with that, thanks so much for watching, and I'll see you guys in the next one.